Welcome to World DNA. This is Advanced Option Greek course, and this is the part 4 of our Option Greek course, wherein we will discuss the last Greek, that is Vega. If you are watching this course for the first time, I strongly recommend you to please watch our previous 3 parts in order to understand this part much better, because the Vega is almost interrelated with all the option Greeks as discussed earlier. So I strongly suggest you to kindly watch all the previous 3 videos in this playlist of Advanced Option Greek course. So let's begin. So what is Vega? Vega is a Greek which measures how the option price will change with respect to 1% change in implied volatility. If you have watched our previous video, you would be understanding that what is implied volatility means. In order to grasp this concept better, I am repeating it here. Volatility is simply the range that the option market is predicting for a stock price. For example, if a stock is currently trading at $100 and its IV is, let's say, 20%, then the option market is predicting that over the expiry, whether it is a week or month for which this volatility is related, how much is the possible range of this stock to move. So if the implied volatility of this stock is 20%, then option market is predicting that this stock will likely to go up to $120 or fall back to $80. So this is the simplest definition of implied volatility. So what is Vega? Vega measures what is the impact of change in implied volatility, a 1% change in implied volatility to the option price. So this is the Greek which is not related with the price of the underlying, rather it is related with the implied volatility. For example, if I bought a call option with a strike price of $100 and this option is currently trading at $2, the option trading software is showing a Vega of positive 0.25. So in this video we are going to understand what is this 0.25 means. So what does it mean? Supposedly I bought it when the stock is trading at $100, and in the market the next morning the IV of such option increases by 5% due to expectations that this stock might be going to fall. So this is the expectations. IV is basically the expectations of the option market. So if the next morning I woke up and the IV of such option is increased by 5%, if all the other things remain constant, for example this stock is remain at $100 and assuming that there is no theta decay, then the option will gain value by $1.25. How it is calculated? 5% change in IV and 0.25 was the Vega. So the option price should increase by $1.25. So the new value option will be $3.25. $2 plus $1.25. So if only the IV increases and all the things remain constant, this is the impact of Vega. So this is the example of Vega. Generally in case of falling markets, when there is a fear in the market, markets are falling like anything, then IV increases. And in case of rising markets, when there is a bull markets start to increasing, then the IV decreases because the fear subsides in the market. So IV is sometimes called VIX and it is also called fear index. So remember, when the fear increases in market, when the markets are falling. So when the market fall, VIX rises. That means IV rises. Reverse is the case when the market starting to rise. When the market rises, the fear subsides and the IV starts to decreasing. Therefore, all the debit strategy where you net buy the options should be adopted when you are anticipating an increase in the IV. Because remember that as explained in this example, increasing IV increase the option price, decreasing IV decrease the option price. So when you buy the options, you should be contemplating that IV should be increasing, and the credit strategies where you net seller of the options, it should be adopted in the decreasing IV environment. Generally what happens with the option buyers is that they buy the option when the IV is topped out, when the fear is topped out in the market, and when they buy the options at here, the IV starts to decreasing and their option price will start to decreasing also. That's why option buyer always complain that, you know, I predicted the market rate, then why I'm getting such a losses. This is due to this fact, they ignore the volatility. So let's move on to the next slide. So this is just the pictorial representation of our last example. I purchased a call option for $100 strike price with a $2 per option, and it has current IV of 10%. So this person is, you know, wanting to know what would be the value of this option if the IV goes to 15% and other things remain constant. So our Volvizy tell him that if you want to predict the value of option value solely due to change in the IV, then check the Vega of the option. So if the Vega of such option is 0.20 and the IV increases by 5%, then all of you now can easily calculate how much the option price will change. 5 into 0.20, that is $1 change, and the new option value will be $2 original value, $1 increase, so the new option value will be $3. So this is just the animatic representative of previous example. Let's move on to the next slide. So how the Vega behaves with different strike prices. As all of you know, in option chain there are multiple strike prices: out of the money, in the money, at the money. So in this, at here we will discuss how Vega behaves across different strike prices. So general principle: at the money options have highest Vega, and as you move out of the money, Vega starts to decreasing. So this is the general principle of option chains. So option traders which likes to play on volatility, solely on volatility, likes to stick around at the money option as they have the highest Vega exposure, and at the money options are most sensitive to IV changes. So remember that if you want to play with volatility, stick to ATM options, and if you know protect yourself from volatility changes, then you need to move slightly out of the money. So option trader which want to stay away from volatility should stick to slight OTM options in order to manage Vega more easily. So this is the example. Let's move on to the example with option chain. So this is the real life option chain of Apple. ATM option is just around here, and if you look at the Vega, the more I move out of the money, the Vega starts to decreasing. 0.09, 0.08, 0.06, 0.04, 0.03. So this is how the principle is proved. So let's move on to the next slide. So how the Vega behaves across different expiries. So what is the impact on Vega due to change in different expiries? You know, one option, let's say one option is expiring in 1 week and another option is expiring in 1 month. So how their Vega is different and how they are interrelated to each other, we will discuss it here. So the general principle: the more far the expiry, the more Vega will options have. Due to this, long-term options are more sensitive to change in IV, that is common sense, rather than short-term options. So what is general principle? The more time that has option to expire, the more Vega it would have. How? And why? Because when there is much more time for the option to move, its possible direction or possible range would be larger. Suppose a stock is trading at $100, and if I ask you, what is the probability in 1 week of 1 week that how much this stock is going to change? Supposedly you calculate it HV, you look at its IV, you would guess that it would probably move $110 to $90. And suddenly if I say, let's forget the week. So suddenly I say you that let's forget the week and tell me what is the probability, what is the possible range of this option or stocks to move in the next 1 month. Suddenly you will find that this range of $110, $90 might be not enough. So in 1 month you will probably say that this might move to 130, or the down it most can go might be 70. So if you just apply just a little bit of common sense, then you can easily grasp this concept. The more far the expiry, the more Vega will options have, and the more short the expiry, the more less Vega will options have. So that's why the volatility traders prefer to sell long-term options when volatility has topped out and start falling due to 3 reasons. So supposedly you are a volatility trader, and there was a fear in the market or a news in the market, the IV or VIX start to increasing, and it is almost has topped out, almost breached its upper part. So always remember that volatility is always stay in ranges. It moves like this. This is not like a stock. If a stock, it can move like this or falls like this, but it is not in the case of volatility. Volatility is kind of sinusoidal. It moves up, it comes down, it moves up, it comes down. It always stays in a range bound manner. So this is the nature of volatility. So what happens when the volatility is topped out? The volatility trader would like to sell options there. Why? Because decreasing IV reduces the options value as the volatility will start falling. In the previous slide we have discussed, when the IV starts to decreasing, option value will also start to decreasing, and you don't want to be an option buyer here in the decreasing IV environment. So decreasing IV reduces options value. Second, as discussed in our theta class, when the IV starts to decreasing, it increases the pace of theta decay. Reverse is the case, when IV starts to increasing, it decreases the pace of theta decay. The third reason, short-term options have much more negative gamma. As discussed in our gamma class, a negative gamma is a nightmare for option sellers. So generally we want to sell options, and to get the benefit of theta, gamma and decreasing IV, they like to stick to the short-term options because they have low negative gamma. If you are somehow getting confused that how it is related with theta, how it is related with the gamma, then I strongly recommend you to watch our previous video. It will help you to learn much more better. So in order to play volatility, option traders love calendar spreads. Calendar spreads are some professional strategies used by pro option traders. In calendar spread, what they generally do, they sell one expiry option and buy another expiry option. Whether it will be far term, near term, it depends upon the type of calendar spread. So option trader who want to play in volatility and also want a hedge against their position in case market goes against their predictive direction, they like to do calendar spreads. So this is a advanced strategy, and we will please do comment if you want video on different option strategies. We will try to explain it, what is calendar spread and what are the different strategies that can be implemented in different volatility scenarios. So this is the Vega, and this is our last click in this advanced option Greek course. Thank you for being such a good audience, and I hope that you have gain a good knowledge about Greeks, and it will help you in trading better. In case of any queries, kindly do comment below, and for further updates I would strongly suggest you to visit voldna.tk, our website, where we provide free volatility charts and free analysis. And do follow us on our Twitter at volvizy Twitter handle. So, thank you for such a good listeners, and please subscribe for more. Thank you very much.